So out of the ashes of that old ownership society and our failed agency society, our job is to develop a new fiduciary society, one that guarantees that we last line owners, we mutual fund shareholders, and we pension fund beneficiaries whose savings are at stake here, have our rights as investment principals protected. And those rights must include, number one, the right to have money managers act solely in our behalf. The client must be king. Two, the right to rely on due diligence and high professional standards on the part of money managers and securities analysts who appraise securities for the principal's portfolios. And that is sadly lacking too great a step. Three, the assurance that our agents, these managers, will act as responsible corporate citizens, restoring to their principals the neglected rights of ownership of stocks and demanding that corporate directors and managers meet their own fiduciary duty to their own shareholders. Four, the right to demand some sort of discipline and integrity, maybe the new Consumer Protection Department can help with this, some sort of integrity in the mutual funds and financial, quote, products, quote, that our financial firms offer. Five, the establishment of an advisory fee structure that meets a reasonable test, a reasonable standard, based not only on rates, which don't really mean much, but on dollars, which mean a lot, or on their relationship to the fees and structures available to other clients of the manager. It's no secret the high fees that mutual funds pay to their managers. They charge their institutional clients only a tiny fraction of those fees. And sixth, the elimination of all conflicts of interest that could preclude the achievement of those important goals. More than parenthetically, I must note that this final provision, elimination of conflicts of interest, would seem to preclude the ownership of money management firms by financial conglomerates, which now happens to be the dominant form of organization in the mutual fund industry. Painful as such separation might be to accomplish, conglomerate ownership of money management is the single most blatant violation of the ancient biblical principle that no man can serve two masters. Well, there's grounds for hope, I think. My words tonight are strong words, I know that. And had I not found agreement with this harsh indictment of present-day capitalism from some of the most respected names in investing and in academia, I might be less certain of my ground. But leaders of great repute in both communities, academic and investment, have stood up and spoken out, and their wisdom will ultimately make a positive difference. One, in his remarkable 2000 book on money and markets, the eminent financier, economist and historian Henry Kaufman put it this way: unfettered financial entrepreneurship can become excessive and damaging as well, leading to serious abuses in the trampling of the basic laws and morals of the financial system. Such abuses weaken a nation's financial structure and undermine public confidence in the financial community. When financial buccaneers and negligent executives step over the line, the damage is inflicted on all market participants, and the notion of financial trusteeship too frequently is lost in the shuffle. Only by improving the balance between entrepreneurial innovation and more traditional values, prudence, stability, safety, soundness, can we improve the ratio of benefits to costs in our financial system. And just a few weeks ago, Idealism, the journal of the American Academy of Arts and Sciences, devoted its entire fall 2010 issue to the financial crisis and economic policy. I commend it to you. Has a nice purple cover. Its lead essay by Harvard professor and acclaimed author Benjamin Friedman asked the question, is our financial system serving us well? Dr. Friedman doesn't think so, and expresses grave concerns about the shortcomings of our financial system in allocating scarce investment capital and the high, very high and growing cost of its operations, the financial system's operations. He concludes that the breakdown in the financial system has inflicted serious damage on our real economy, damage that may last for years. Solving these problems goes far beyond the tinkering with the system that, alas, characterized much of the recent Dodd-Frank financial reform legislation. It was okay, but it didn't do nearly as much as it could have done. The solutions will require the wisdom and objectivity of dedicated academics, combined with the intelligence and experience and independence of the most integrity-laden leaders of corporate America and investment America alike. Further, Democracy being democracy, as we know after last night finally ended, even the most promising solutions for restoring our powerful but flawed financial system will ultimately require the perspective and understanding of our elected representatives, the new Congress that is now in charge, and also, of course, of our President. We need academic leaders, private sector leaders, and political leaders with the courage and character to fix what has been broken. To say the least, there are never enough such extraordinary leaders to allow us to envision an easy road ahead, and there may even be fewer than usual in the financial field, but there are some of them out there. But all of us are part of the solution, too. And understanding and discussing the issues which I tried to help you with this evening will require an informed citizenry to begin to tackle the monumental tasks that lie before us. Thank you very much.